All right, today we're going to talk about the rule of 40 as it relates to SaaS metrics. Now, the reason I want to cover rule of 40 is not only is it like one of the most popular SaaS metrics that's out there to help evaluate SaaS companies, but also because I think it illustrates really well why investing in SaaS businesses that aren't profitable can actually make a lot of sense. I mean, if you think about it on its face, right? Because SaaS businesses have this concept of recurring revenue, right? And this very strong like predictability and lifetime value of that revenue, it can make a lot of sense to be investing a lot of money into marketing and sales to acquire those customers now, knowing that it will pay off over time. What happens is you could be, as a business, spending a ton of money to acquire new customers and not seeing the payout of those acquired customers for years on into the future. And so it looks like your business is losing a ton of money today, but if you were to just stop all marketing spend and just rely on your current customer base, many of these SaaS businesses could turn profitable overnight. And thereby you have this trade-off between profits and growth. And that's really what the rule of 40 is trying to capture. So where did the rule of 40 come from? So the rule of 40 really traces its roots back to two blog posts by Fred Wilson and Brad Feld, both phenomenal venture investors that were on the same board of this company. And there was a growth stage investor who brought up this concept of the rule of the 40. They liked it so much that they both ended up blogging about it. And from there, it kind of picked up and grew, and now has become one of the standard metrics that people use to evaluate SaaS metrics. So on its face, what does the rule of 40 say? Well, it says that your growth rate plus your profit percentage, your profit margin, should equal at least 40%. Ideally higher, but at least 40%. And thereby you get into this trade-off between growth and profits. So let's do a few examples on the whiteboard to explain and really illustrate what I mean by that. All right, so let's say we've got company A, company B, and company C. Company A is growing 100% year over year. Company B is growing by 20% year over year, and company C is not growing. Just flat, steady. Maybe it grows like 1%, other years it declines a little bit, right? Up and down. Okay, so this is our growth rates. And then let's have our profit margin. Now, sometimes it also is called sometimes people will also use EBITDA margin instead, but just for the sake of this exercise, let's assume that it's the profit. So in this case, company A, if they were losing 60%, so company A is losing 60% every year, right? Negative 60% profit margins. Company B is generating a positive profit of 20%, and company C is very profitable at 40%. Well, in all of these cases, if I add these two up, right, then in this case, I get 40%. In this case, I get 40%. In this case, I get 40%. Now, you could argue that all three of these situations are pretty good situations if you think about it, right? Company A is growing by 100% year over year, and really what they're probably focused on is driving as much kind of customer adoption, kind of building out their empire, growing as much as they possibly can. And over time in the future, you'd expect this growth rate to start to decline similar to company B. And maybe in the very, very long run, as a company kind of fully matures and plateaus and dominates its market, ends up being like customer C or company C. Company B and company C. Company B is a good example of a company that's gone public and has been public for a few years. It's no longer growing at 100% year over year. It's rather growing at a really steady 20%. And because of that, because it's not growing as fast, it necessitates that it's at least generating some, 20% profit margins to remain within the rule of 40. And then you have company C. Now, company C, when you think about like companies like Procter & Gamble. Now, Procter & Gamble is not really a SaaS business, but you think about diapers, right? Let's be honest, like the market for diapers isn't really growing that much. It's growing at like the rate of the population growth. And so, their growth rate may be relatively flat. But, Procter & Gamble with their products, they pretty much dominate the market. And so they have relatively high profit margins, even though they're not growing. And that's okay too. And that's what you'd want to see here. Now, generally speaking, investors are going to reward growth more than they're going to reward profits. And that's just because investors, in my opinion, get excited about what the future holds, right? And where things can go. Now, let's look at these where they break the rule of 40, right? Would you want to invest in a business that's only growing 20% and has zero profit margins? I mean, that would infer that they're investing everything they can just to maintain 20% growth rate. Right. And if they've got competitors that are growing faster than they are, like if you were comparing company A to company B, you would definitely want to invest in company B because they're growing so much faster. And company B is probably in a position where company A is going to outstrip them in terms of their market size. They're probably going to steal customers from them. And company B is going to struggle to generate enough profits to reinvest in the business to be able to compete effectively against company A. And eventually company A can get to a place where they say, you know what? We're going to trade our growth for profitability, and we're not going to spend as much on marketing anymore, because as you get bigger, it becomes more and more costly to acquire that incremental customer, right? You get all the low-hanging fruit, and then you got to pull out the ladder to start reaching up to the upper branches of that tree to get those additional customers. It just becomes more and more costly. And so there becomes this like diminishing marginal return to spending on marketing when you could start flipping things and paying out more in terms of profits. And then the other thing is you also hit this like inflection point for most SaaS businesses where the legacy customers all of a sudden become large enough that they outweigh the number of new customers that you can bring on in any given year. And the revenues that those legacy customers generate finally become large enough that they start paying all of the marketing expense for new customers. And actually generating real profits. Typically, though, when that's happening, you start to see the growth rate really start to plateau because it's way harder to go from $1 billion in revenue to $2 billion in revenue than it is to go from $1 in revenue to $2 in revenue, right? So just organically, you're going to see a decline in year-over-year growth rate. It is insanely difficult to maintain, 40% year-over-year growth rate. And even if you look at like rule of 40, so Adobe, for example, sits at a phenomenal 54% for their rule of 40. So they're absolutely crushing it. But this is a combination of a 10% year-over-year growth rate, so not that high of growth, and a 44% profit margin. And so you can see like even Adobe, which is a phenomenal company, only growing at like 10%, but huge profits, and thereby getting a phenomenal 54% on their rule of 40, puts them in a very dominant position. And that's also part of the reason why Adobe has an extremely high valuation relative to some of its peers. And in fact, in the chart that I'm providing here, you can see like that difference in terms of where the company sits on that rule of 40 across the bottom, and how the market is putting a value on them. And generally, and it's not, accurate 100% of the time, but it's generally accurate to say that the stronger your rule of 40 is, right, where you're capturing both growth and profitability, or one or the other at an extreme level, investors are going to pay up for that type of business. Now, I want to talk just a minute about areas where the rule of 40 really breaks down and is not as helpful, and why you can't really look at it in isolation. And probably the biggest one is if you think about what goes into the calculation, it's about growth rate and it's about profitability. Well, profitability is going to be calculated based on taking out your cost of goods sold, your operating expenses, your marketing and sales expenses, your R&D, and all of these things, right? At the end of the day, you get growth by investing in sales and marketing, right? If I put money into sales and marketing, I would hope to see a return on that in terms of revenue growth. Well, in some cases, you might have a business where, the company is burning a lot of money, but they're not necessarily spending it on marketing and sales. And so maybe if you think about this in multiple years, maybe in year 1, they spent a lot of money on marketing, and that led to a really nice growth rate, right? At the end of that year. But then in year 2, they stop spending on marketing and they start spending on something else. Maybe it's like R&D, right? And maybe R&D is ultimately going to pay off because they're going to create a new product and that will result in more growth. But what if it doesn't pay off, right? Well, in that period, you could look at it and be like, wow, well, they grew by 100% and they're still burning, a lot of money because they're spending it on all kinds of things. But instead of spending on marketing, they're spending on R&D. R&D doesn't actually pan out. The product doesn't work. And instead of spending that money on marketing, which would have had a more direct correlation with growth, right, the company has a flop. And so it's important to understand like what the company is actually spending money on and why their profit margins are the way they are to get a better, more holistic view of the impact of the rule of 40 and whether or not it makes sense to use it as a metric for the companies that you're evaluating. The last thing is that I'll just say is that like the 40 number it's a little bit of like a number pulled out of the sky. It tends to hold up pretty well, but there's not a tremendous amount of science backing why it should be 40 and not 35 or 50 or whatever it might be. I think it's mostly just like feels like a really good number to evaluate those offsets and those trade-offs between growth and profitability. Anyways, I hope this video was helpful in terms of learning more about what the rule of 40 is, why it matters, and some of the caveats to the metric. Be sure to check out some of my other videos, like where I talk about what a liquidation preference is as it relates to term sheets and venture capital. Thanks.